Good morning, everyone, and thank you for joining us for our financial year in review. I'm Deanne Rosso, President and CEO of Elevate Wealth Advisory. If you're new to us, Elevate is a wealth advisory firm in Athens, Georgia, and we focus on preparing our clients to confidently live their best lives. We were founded 40 years ago by Chuck Vickery, who's also with us today, and we rebranded last year to better reflect our growing team. Today, we have with us two colleagues, Mike Osborne and Brian Haywood from Buckingham Strategic Partners, which is the company we partner with in order to service our clients in a more meaningful way. As I mentioned, we also have our founder, Chuck Vickery, with us today, and our wealth advisors, Clarke Holt, David Jenkins, and Rob Fizikis. So welcome, everybody. Before I introduce Mike and Brian, just a couple of items. Many of you have already sent in questions, but if you think of questions during the presentation, you can place those either in the Q&A box or the chat box, and we'll answer those if we have time at the end. If we don't get to your question, you can email us at marketing@elevate-wealth.com, and we'll be sure to get back to you. Later today, you'll get a link to the recorded webinar on our YouTube channel. So feel free to share that with your family and friends if you find anything of interest in our webinar today. So now I'd like to introduce our panelists. As a divisional manager for Buckingham, Mike Osborne partners with financial advisors to help them provide better advice and investment experiences to clients. Buckingham's areas of focus include Nobel Prize-winning economic theory, investment management, and best practices in growing and maintaining a successful wealth management firm. Prior to joining Buckingham, Mike was with CNL Securities, working as a senior vice president. And his background also includes many years as managing director for a leading alternative investment firm. He began his career with Merrill Lynch in Jacksonville, Florida. Mike graduated from, we won't hold it against him, Florida State University with a Bachelor of Science in Economics, but he made up for it because he earned his certificate of financial planning from the University of Georgia. Mike and his wife, Mary Hadley, reside in Lookout Mountain, Tennessee with their 4 children, and he loves watching and participating in sports, and he coaches youth football, baseball, and basketball. He also enjoys traveling with his family. Welcome, Mike. Brian
Thanks
Haywood.
for having us.
Sure, we're glad to have you today. Brian Haywood is investment strategy advisor, and he takes pride that in an industry where decisions are often driven by commissions and not conscience, he and his team spend their time customizing portfolios on behalf of Buckingham Strategic Wealth clients, upholding their fiduciary responsibility by doing what's in the best interest of each client. Brian's also a member of the firm's investment policy committee, lending his insight on the firm's overall investment strategy. Prior to joining Buckingham, Brian was a retail sales assistant for UMB Brokerage Services, and he holds a bachelor's degree from St. Louis University. Brian is a passionate supporter of the Gateway Area Chapter of the National Multiple Sclerosis Society, and he's a 7-time participant in the organization's Bike MS event, a long-distance cycling event that has raised more than $1 billion for the organization since 1980. Brian and his wife, Rachel, live with their daughter, Ella, in Afton, Missouri. And I understand that Ella has taken on the love of her dad's cycling as she wants a bicycle for Christmas. Is that right, Brian?
She has, although she doesn't want to wear the spandex for some reason. I don't get it.
I could kind of see that, though. Welcome, Brian.
Thank you.
So Mike and Brian, thanks so much again for joining us today. Why don't you give us a brief overview of 2022, and then we'll get to some of our clients' questions.
Sure, happy to discuss it. So I'm sure I'm probably not breaking any news here, but obviously 2022 has been a very challenging year for both equity and fixed income markets. So as of the end of last week, U.S. stocks were down roughly 17%. As measured by the Russell 3000 index, although it looks like we're poised for a good day today with the inflation print coming in a little bit lower than expected. So that's a bit of good news. I saw futures on the Dow at least were up about 2% today. So poised for a good day today. International stocks have performed slightly better, but still they've had a challenging 2022 as well. They're down approximately 14% if you're looking at the MSCI World ex-US Index. And emerging markets have actually suffered the most in 2022, and they're down approximately 18%. So all of them are kind of in that the mid to kind of high teens as far as returns go. So that negative 18% number is looking at the MSCI Emerging Markets Index. So I will say in general, our portfolios have tended to fare a little bit better in the overall market as our tilts towards value stocks in both the US and international have boosted returns a bit. And I'll talk a little bit about that more as we get later into the presentation here. Now, typically in a year where we have quite poor equity performance, you typically see high quality fixed income do quite well, as obviously people seek shelter in those high quality assets, those safer high quality assets. But unfortunately, we've seen just the opposite as the Fed has been forced to raise interest rates significantly here in 2022, driving rates up to combat the high inflation we've seen in 2022. So US investment grade bonds are down about 12% year to date. And that's looking at the Bloomberg US Aggregate Bond Index. That's a index of all investment grade bonds within the United States. Now, within the fixed income space in general, shorter duration or shorter maturity fixed income has fared better than longer maturity. Fixed income and high quality bonds have performed slightly better than lower quality issuers. But all in all, again, I'm sure I'm not breaking news to anyone on the call here. It's been a challenging market on multiple fronts.
Yeah, it has been a challenging market, and you briefly described this, but can you share a little bit maybe more about what we've seen happen in the bond market?
Yeah, so the bond market has been experiencing basically its largest sell-off in 40 years, really since kind of the early 1980s. Now, that poor performance has been driven by a significant increase in rates due to the Fed's policy towards reducing inflation, or rather expectations for the Fed's response to inflation. So coming into 2022, the Fed at their December 21 meeting had signaled they would likely need to raise the Fed funds target rate. And they were thinking coming into 2022, they'd need to raise it only 3 times to combat inflation. As I'm sure you're all aware, we've raised it more than 3 times in 2022. Basically, a 325 basis point hike is a regular meeting at this point. So as 2022 progressed and inflation remained stubbornly high, the Fed realized that they would need to raise rates higher than they initially thought. So the persistently high inflation we've seen in 2022 has forced the Fed to raise the target rate from basically 0 to where we are today, which is 3.75 to 4%. So that's an astonishing rise in 1 year. And it looks like we're not done. So it looks like tomorrow the Fed will likely raise the target rate another 50 basis points. So we'll put us at about 4.5%. And then as of yesterday, it was looking like possibly another 50 basis points in 2023, early in 2023. So at the February or March meeting. So everybody is kind of looking at roughly kind of a 5% terminal rate for the Fed funds in 2023. So, we should expect a little bit higher rates possibly in 2023, but nobody is predicting, large shifts like we saw in 2022 to continue.
Although one thing I will say, Brian, is nobody predicted, as you mentioned earlier, nobody predicted what we've seen this year. So predictions sometimes are as good as the piece of paper they're written on.
That is true.
And I think our next question comes from advisor Rob Fazekas.
Yes, hi. So it sounds like diversification might not have worked as well this year as it usually does as far as combining stocks and bonds within a portfolio. But I wonder if you could talk a little bit more about how diversification might have worked within areas of the stock and bond markets.
Sure, great question. I've touched on it a little bit, but basically when we think about diversification in the markets, we think about them through the lens of premium. So how did value stocks do versus growth stocks? How did small cap stocks do versus large cap stocks? So looking within the equity space, what we've seen is As far as the size premium goes, it's been negative. So that means in general, we've seen in the US large cap stocks outperform small cap stocks, but we've seen a pretty robust value premium. So value stocks, and when we say value stocks, these are stocks that have lower prices relative to their book value. So in general, we've seen a pretty strong value premium. So value stocks have performed quite a bit better than growth stocks within the US. So that's why we've seen kind of in general, our portfolios have tended to do a little bit better than the market. You know, they're still negative over the course of the year, but less negative than kind of the broad indexes. Switching over to developed ex-US, it's basically been a similar story. So again, large caps have slightly outperformed small cap stocks by about 4%, but value stocks have outperformed growth stocks by about, let's call it 15.5%. So pretty strong value premium in developed ex-US, and pretty much same story in EM, slightly negative size premium, but value stocks have significantly outperformed growth stocks.
Couple things I'll add, Rob. Internationally and really across the board this quarter, we've seen a nice comeback in the markets, but international stocks are up 18% this quarter. So Europe, Japan, so that's been a nice run. And then another shift we saw, you know, a surge in large tech companies, and heard a lot that maybe it's different now that these tech companies, big tech is going to dominate. And if you look at large tech this year, they're up pretty good today, it looks like. But as of yesterday, large tech was down about 32% year to date. So we don't have a focus on large tech. And again, as Brian pointed out, our portfolios have done better than what just the US average or anyone that has a focus on technology in their portfolio.
Yeah, thanks, Mike. And then switching over to the fixed income side of the market, we tend to build portfolios kind of in the short to intermediate space. So our portfolios have tended to hang in there a little bit better than the overall market. So just to give you an idea, kind of the 5-year global fund from DFA, I would say that's a pretty good proxy for kind of what we're doing on the mutual fund side, but also what we're doing with individual bonds on the desk. And that fund is only down year to date about 6%, a little more north of 6% compared to the overall market, which again is down almost about 12%. So our portfolios have hung in there a little bit better. Most of that is due to the fact that we have stayed towards the shorter end of the yield curve. So shorter maturity bonds have hung in there much better than longer maturity bonds, as obviously the longer the maturity of a bond, the more sensitive it's going to be to changes in interest rates. And then we've seen higher quality bonds slightly outperform high yield bonds by about 1%. Again, this year has been more about interest rates as opposed to any kind of underlying credit concerns. Although, you know, looking forward to 2023, if we would tip into a recession, you know, I would expect those credit spreads to widen, and I'd expect, you know, kind of lower quality, high yield bonds to have performed worse than their investment grade counterparts.
Thanks, guys. I believe our next question, a couple of questions come from our founder and wealth advisor, Chuck Vickery. And yep, Chuck, you're muted. There you go.
Okay, Brian, Mike, thanks for joining us today. We appreciate it. We know y'all are busy.
Our pleasure.
You know, I know trees don't grow to the sky, but what the question people keep asking me is, what is the outlook for interest rates and inflation? How high is it going to go?
Sure, great question. So we can get a lot of information about what the market is thinking by looking at today's yield curve, as well as the Fed funds futures market. So when looking at Fed funds futures, which is basically a gauge of how high they expect or where they expect the target rate to be. So the market right now, at least of when I looked at this yesterday, I haven't gotten an update today since the inflation print came in. I'm imagining it's probably lower. But when I looked at it yesterday, the market was basically 100% expecting 50 basis point rate hike tomorrow at the Fed meeting. And I don't believe that will change, even though we have gotten a better CPI number here this morning. Now, where we could see some changes are some of the predictions looking forward into 2023. So yesterday, the expectation was for about a 65% chance of a 50 basis point hike at the February meeting from the Fed. That's their first 2023 meeting. So that would put the Fed funds target rate at basically 5%. And that's basically what the market was predicting. Hey, we're going to hit 5, and then the market's predicting that the Fed is likely going to pause and just stick right there for the time being, with the potential of maybe even lowering the target rate late in 2023. So with today's print, that might have changed. We might not even get to 5. Maybe they're looking at only a 25 basis point hike in February. But, the market, as we sit today, is not predicting the Fed to raise it significantly in 2023 like they did in 2022, as we seem to have hit kind of peak inflation, and inflation seems to be moderating and starting to come down. Now,
Chuck, just going to add a couple points there, Brian, that are positives. First of all, if you're going to the pump, you've noticed a difference lately. Gas prices, they're down about $1.50 nationally since June. And then the other thing that you're seeing is we had a real bottleneck with just supply chains in general. COVID, it started with the war in Ukraine, didn't help. You read about tanker ships that were docked out for days or months, and we're seeing that clear up too. So we should see more supply, which will ultimately will help those inflation numbers over the long term.
Yeah.
So I had a client yesterday, as a matter of fact, asked me, said, my account's down about 7%, so I guess we're in a recession. So I'll ask y'all, are we in a recession, and do you see one coming?
So if you looked at earlier this year, traditionally the definition of a recession had been 2 negative quarters of GDP growth. Now, we actually did get that in the first and second quarter of 2022. Now, it was shallow, but there were 2 consecutive negative quarters of GDP growth. So some argued, yes, we did experience a slight recession in early 2022, but the National Bureau of Economic Research, which are, I guess, the ones that officially declare a recession, did not declare a recession. Now, we got the growth numbers for the third quarter, and it was positive. So we can say today is we are not in a recession. Now, looking forward, though, there are a number of market participants forecasting that there is a decent chance of us falling into a recession in 2023. Obviously, what the Fed is doing is attempting to curb demand, which is not good for economic growth, and they're trying to curb demand in order to bring inflation down. So, could we be in a recession in 2023? I think you definitely can say there is a decent likelihood that we could be in a recession. Just looking at the yield curve is actually inverted. So what that means is short-term rates are higher than long-term rates, and that traditionally has been a pretty good indicator, a pretty good leading indicator of a recession. So the market is forecasting a decent probability of being in a recession. Now, as Mike kind of alluded to earlier, predictions aren't really worth a whole lot, as nobody was predicting inflation to be as high as it was in 2022, and the Fed to do what they did. So, there's no guarantee that they will, but some market participants are saying that. But I would not base any investment decisions on the chance or any probability of us being in a recession in 2022, or excuse me, in 2023, as the market has already kind of priced that information into prices today.
Okay, great. Thanks, guys. Appreciate it.
My pleasure.
Well, I think that's a great segue to David Jenkins. David, what have you been hearing from your clients? What questions have they had for you?
So Brian, like you've mentioned several times, it's been a challenging year, and people are wanting to know, are things going to get worse? Can they get worse? And if they do, should they get out of the market, or should they make some changes to their investments? What are your thoughts there?
Yeah, great question. So, I think it's important to recognize that markets, whether they be equity markets or fixed income markets, are very efficient at pricing in all available information into prices, as I just previously mentioned. So all of this information that we're talking about, supply chain issues, oil, the war in Ukraine, all the geopolitical issues with China, all these various things are all known about, and they're all priced into the market as we sit today. So, not to bury the lead here, but I'd say no, I would not make any changes based on any prognostications about the market. But just taking a step back, to try and time the market in this fashion, an investor would really need to be right, not just once, they need to be right twice. So let's say markets were wrong and we have a much deeper recession, and the market goes down another 15-20%, and we time it right. Great. The flip side of that is we then have to time it right again as far as when to get back in. And there's no green light that tells us, hey, now is the market's bottomed out, it's time to get back in. In fact, usually it's looks the darkest and most bleak, that's the time to kind of get back in. But that's really, really hard thing, psychologically to do. So if you time that re-entry point incorrect, that could have just as dire consequences, and you could actually have a worse investment experience than if you just wrote it out. So, and that's taking, taxes and all the other costs out of the equation, because that's going to be a pretty big tax bill if we're going to sell out of everything. Even though we've had a down year, up until now, we've had, a really, really great run here in the market. So that's a huge tax bill to realize all those capital gains and all the trading costs that come along with that. So we would say, some of the, all the news out there is already priced in. So the only way you can really profit from this would be if you think markets are wrong and prices should be lower than they are today. So long story short, don't make any changes unless you look at your overall situation and feel like you need to take less risk or want to take more risk. I would say those should be the things that drive the decision to make changes to the portfolio, not any short-term, market-driven decisions.
David, I'd agree with that. And the financial plan should really dictate changes to the stock and bond portfolio. One example I'll that's still fairly recent, I think everyone remembers, is look back to 08, 09, the financial crisis. And the bottom of the markets, I believe, was March 9th of 2009 is when we hit bottom. So that would have been the time that you would have want to go all in on stocks. But the economy actually got much worse for about 18 months. Unemployment went up to 10%. The housing market just crashed and was awful. but the market went on a tremendous run. So what a lot of people want to do, they want to read the news and make their decisions on what I do in the stock market. And to Brian's point, it's too late to do that. And usually when you feel the worst is when a lot of times we see the market actually rebound. The market is forward looking. So trying to time things based on economic news is a really tough game to play.
Yeah, agreed. Very, very difficult to try and time the market. And I think it's great suggestions from you guys. Just stay the course, which has been our philosophy from day one. And take a look, review that financial plan, make sure that you're on course, make sure that your risk is in alignment with your long-term goals. So great advice from both of you. And now we'll shift over to Clarke Holt with a couple of questions on behalf of his clients. Clarke?
Thanks, Deanna. Hey, Brian. Hey, Mike. Thanks for being with us. A question that I get a lot, and I'm sure my colleagues have as well, just with this recent performance, maybe the last 10 years for international equities, obviously underperforming US, and then the outlook and maybe, certainly places like Europe and others not being as great. The question is, should I own individual stocks? And if we do, like what allocation should be committed to that asset class?
Yeah, we feel this question a lot as well. So not to not to ruin the plot here, but yes, we do believe clients should own international stocks, and there's a number of reasons for that. First and foremost, international, and when I say international, I'm lumping in emerging markets into that bucket as well. That represents about roughly 40% of the entire investable universe. So we would argue, there's nothing special or unique about US stocks that you should basically ignore 40% of the market from just a sheer diversification standpoint. So it's a massive part of the market. So we believe you should own that. Now, looking at returns, there's no doubt US stocks have performed great over the past 10 years. In fact, if you look at individual country returns, the US is at the absolute top of that list. But it hasn't always been there. It kind of fluctuates from time to time. And I wanted to point out that if you look at actually decade by decade returns of US stocks versus international stocks, it's not unusual. This is not unusual at all for one of those two to outperform the other for a significant period of time. So just to give you an idea, looking back to, going back all the way to 1970. So from 1970 through 1989, actually international stocks for a full 20 years outperformed US stocks. So over the period of the 1970s, international stocks outperformed US by the tune of about 3% on average per year. In the 80s, that jumped up to about 4.5%, 4.4%. Now, obviously, in the 90s, that flipped, and US outperformed international. But then going back not too terribly far to the 2000s, actually international stocks outperformed US stocks by about 2%, 2.1%. Now, again, 2010s, it's flipped. So it's not unusual for one of these groups to outperform the other for a long period of time. So we would say, we don't know when that's going to flip, but it can flip in a moment. In fact, international stocks are outperforming US stocks this year. So we would still say choosing international stocks is still an important part of a client's portfolio. And one last thing I want to point out is because US stocks have performed so well recently, just if you look at their valuations are significantly higher than the international counterparts. So for example, in the US stocks on average are trading at a price earnings ratio of about 19. So in other words, basically investors are paying about $19 for every $1 of earnings for US companies. And this is above the long-term historical average of about 17. So, if you're projecting forward, you would expect US stocks to have lower returns than their kind of historical average. On the flip side, ex-US developed stocks are trading at a PE ratio of only about 12.6. So you're only paying $12.60 for each dollar of earnings. And that's pretty well below the historical average outside the US of about 16.5. So just looking at valuations, we'd expect higher returns based on valuations in the international space than we would in the US. So that's another reason we would argue that clients should allocate to international stocks. And when looking at portfolios, I would say the vast majority of clients are pretty much in line with kind of world market cap. So about 60% US, 40% international. Some have gone 50-50, but in general, we'd say 60-40 is where most clients should be, and that's where they tend to fall.
Clarke, one other point there is I like to remind everyone that you're not buying a country when you invest in the stock market, you're buying companies. And there's great companies all over the globe. The US has runs, to Brian's point, where the US has high returns. And we've seen the other way with international stocks, as Brian mentioned. We had the lost decade not too long ago with US stocks, where S&P 500, you basically had zero return for 10 years. And we just haven't found a reliable way. Really, no one has found a reliable way to be able to time, when to get into the US, when to get into international. So again, sticking with your plan, having a diversified portfolio is typically going to win over time.
I agree. Thank you both. Another question that I get, and I'm sure, again, others do as well. And Brian, you mentioned this earlier, the fixed income performance this year, and it maybe back to the 80s, since that's happened before, and of course inflation and things like that. So this is the great all-timer of questions, or comments. People will say things feel different this time, and the question is, have we seen this before? Have we seen these types of things before? And so I'd love to get your take on that.
Yeah, I think a lot of this comes down to recency bias, because have we seen something like this before? Yes, but it's been quite a while since it has happened. So this really has a lot of today's economy has a lot of hallmarks of kind of the early 1980s, although not quite to the same degree. So, coming into the decade of the 80s, the U.S. economy as well as the rest of the globe were already experiencing high rates of inflation, which is exactly what we're seeing today. I mean, inflation is not just a U.S. problem; it is really a global problem. We're seeing it, all around the continents, and that was exacerbated, at that time by an oil crisis caused by the Iranian Revolution, which again sounds a little familiar as the war in Ukraine has definitely had an impact on global energy prices as well. Now, in response to what was happening at that time, the Federal Reserve under then Chairman Paul Volcker raised the Fed funds target rate significantly, which did lead to a period of stagflation, with the U.S. economy actually experiencing a double-dip recession early in that decade. They raised interest rates, thought they were kind of done, took their foot off the gas a little bit, and the recession kind of came back. So by 1983, they finally did get inflation under control, but not until we saw the economy contract by 3% and unemployment rising to over 10%. Now, am I saying it's going to get that bad this time around? Looking at what we're seeing right now, it doesn't appear to be that way, as obviously we still have an unemployment rate that is still well below 10%, I think 3.8, 3.9, something like that. And obviously the economy is still growing. So we're not contracting. Could we see some contraction in 2023? Possibly. But I don't think it's going to get to that point, as we're already kind of starting to see inflation start to wane here. So, what I will say though is, despite all that bad news of the early 80s, that did set us up for a very robust U.S. economy for the rest of that decade. So, looking at today, again, we have high inflation, but nowhere near as high as we saw in the early 80s. Early 80s, it peaked at 13.5%. And unlike the 70s, the Federal Reserve has appeared to learn some valuable lessons from that time. So, it looks like we have lived through a similar situation, and the Fed has learned a lot of lessons since then, and they've really pivoted from trying to put the economy into a soft landing to, we've got to quash inflation, because they don't want to let it get as out of control as they did in kind of that early 1980s time frame. So we have lived through this before. It's just been a long time, and unfortunately, a lot of us just don't remember that, because 40 years ago was basically another generation ago. So yes, we have seen it. We're living through it, and it looks like, from my own personal opinion, the Fed's doing a good job now. Now, you could argue that they were a little late to the party in terms of raising interest rates, and they probably should have been doing that in 2021 to get out ahead of this more. But I think they've done a good job in terms of fighting inflation in 2022, and really putting their foot to the floor when it comes to squashing inflation.
Well, I think we've gotten to just about everyone's questions today. And just to wrap up, we often say that it's hard to be a long-term investor in a short-term world. And with that, I'd love just, Brian or Mike, your final comments as we wrap up 2022 and head into 2023.
Yeah, I would just say, and Mike and I have both alluded to it, stick to the financial plan. All of the academic and practitioner research, shows that it is incredibly difficult to time markets, whether that be fixed income markets or equity markets. And more likely than not, factoring in trading costs, factoring in taxes, trying to time the market is a loser's game. So stick to your plan. Talk with your advisor. If you're uncomfortable with the risk you have in your plan, talk to your advisor about maybe potentially taking some risk off the table, but don't let the market dictate your plan. Let your goals dictate your plan.
Great advice.
I would agree, Deanna. I would just echo your comments that it's tough right now. We're just bombarded with information. It's everywhere, and there's a reason. Took my kids to a horse race over the summer, and there's a reason the horses have blinders on. So the as much as you want to look every day what your account's doing and try to react, it's not healthy. It's not good. So stick with your plan. Try to stay focused, and usually when you want to get out of the market, it's too late. It's when that's the worst time to sell. It's normal to be concerned. It's normal to want to talk about it. And that is really the benefit of having the team at Elevate there.
Well, thank you guys so much. And, I think we've spent the majority of our time together today talking about the markets and the investments and wrapping up what the market looked like year to date 2022. And we often just say, focus on what you can control. And I think that that's what we're here to help you guys do, our clients. And I think you've all contributed great insights and thoughts into that today. And we thank you for joining us for that. But what we do for our clients, it goes beyond investing. So we want to help you guys focus on what you can control. with regards to your investment portfolios, but also with regards to other areas of your financial plan. So do you feel like from a tax perspective, your plan is aligned with your overall goals? What about legacy planning? Is your estate plan in line? How about from a risk management perspective? Do all of these pieces fit together in your overall financial picture? So that's what we're here to do. And we're here to help guide you through all of those aspects of financial planning. So feel free to reach out to us. Thank you, Mike and Brian, for joining us today from Buckingham. And thank you to all of our Elevate Wealth advisors for joining us today. Thank you to Betsy Kenyon, our marketing coordinator, for coordinating today's webinar. And if you have further questions, feel free to email us. We'd love to be sure you got an answer to a question that you may not have asked today. You can email us at marketing@elevate-wealth.com. And check out our website, elevate-wealth.com. You can find lots of links to upcoming webinars. We have our blog there. We also have all of our previous webinars and our WealthWise video series. You can find that on our YouTube channel. So feel free to follow us. We're on all of the major social media channels, Facebook, LinkedIn, Instagram, most importantly, YouTube, where you can find the recordings of webinars like this and our WealthWise video series. So just look for Elevate Wealth Advisory in Athens, Georgia, and make sure you find the one that's in Athens, Georgia. But thanks again for joining us today. Happy holidays and best wishes for 2023. Thanks, everybody.